Okay, hi there, everybody. I am doing this recorded lecture for Chapter 14, the second chapter that we're covering in Intermediate Accounting 2. And in Chapter 14, so Chapter 13, we talked about current liabilities. In Chapter 14, we're talking about long-term liabilities, namely bonds payable and long-term notes payable. So again, some of this is going to look familiar to you because back when we did our Chapter 6 present value, future value chapter, we talked about long-term liabilities because we do use some of those present value calculations, present value of one, present value of annuity calculations for the bonds and for the long-term liabilities. So some of it'll look familiar to you, but again, we're going to get practice in class with it together. So anyway, I will share my screen with you and we'll get the PowerPoint pulled up. Of course, I'm getting ready to start a recorded lecture. My daughter has to come in here. Okay, so chapter 14, again, we're talking about, oh, hot dog. What did I do? I went into some funky thing. We're talking about long-term liabilities. So some of these overall learning objectives describe the nature of bonds and indicate the accounting procedure for bond issuances, describe the accounting for the extinguishment of debt, explain the accounting for long-term notes payable, describe the accounting for the fair value option, indicate how to present and analyze long-term debt. So long-term debt, again, we think of current liabilities we expect to pay off within 1 year of the operating cycle. Long-term debt takes longer than a year, right? So consists of probable future sacrifices of economic benefits arising from present obligations that are not payable within a year or the operating cycle. And so some of these examples: bonds payable, long-term notes payable, mortgage payable, pension liabilities, lease liabilities. Issuing bonds. So when a company wants to raise a large amount of capital, and again, the next chapter, chapter 15, we get into the statement of stockholders' equity section more, and then we talk about stock issuances and stuff in chapter 15. So we get a little bit more into this too in chapter 15. But basically, when a company wants to raise a large amount of capital, they can do that through either issuing stocks or issuing bonds. So issuing bonds is considered debt financing because we have to pay back the bondholders at maturity. Issuing stocks is considered equity financing because when we issue stocks, we're giving up a percentage or a portion of our equity. So issuing bonds, a bond contract is known as the bond indenture. Represents a promise to pay a sum of money at a designated maturity date, plus periodic interest at specified date on the maturity amount. So just like it shows here, interest payments on bonds are usually made semi-annually or twice a year. So, essentially with the bond, we're going to pay bondholders interest twice a year, and then we're going to pay them the original amount or the face value of the bond back at maturity, right? So, like I said, a company wants to raise a large amount of capital, they can do it by either issuing bonds or issuing stocks. Bonds we call debt financing because we have, companies have to pay that back. It's a debt that they have to pay back. Issuing stock, that we're going to talk about more in chapter 15, is equity financing because we're essentially giving up a percentage of our equity when we issue stock. So some different types of bonds: secured versus unsecured, term, serial and callable bonds, convertible, commodity backed or deep discount bonds, registered and bearer bonds, income and revenue bonds. So just like it talks about in your book, and it has this actually page 720, page 721, secured versus unsecured. A secured bond is when there's some type of collateral that goes with it. Unsecured, there is not a collateral with it. So secured bonds are backed by a pledge of some sort of collateral. Mortgage bonds, for example, are secured by a claim on real estate. Collateral trust bonds are secured by stocks and bonds of other companies. So it has some type of collateral attached to it, whereas unsecured bonds do not. Term, serial, and callable bonds. So a term bond, for example, if we issue, 5-year bonds, then that's the term. It's a 5-year bond. It matures in 5 years. Okay. A serial bond, we might have a 5-year serial bond, but what happens with a serial bond is that 20% of it, for example, matures year 1. 20% matures at the end of year 2. Another 20% matures at the end of year 3. Another 20% matures at the end of year 4. The final 20% matures at the end of year 5. So it's a serial maturity, essentially, with serial bonds. And then callable bonds are bonds that have a provision in the contract that just says that, even though it might be a 5-year bond, the company can pay off the bondholders after 2 years if they want to, or after 3 years if they want to. They can call that debt back. They can call that bond back and pay off that bond even before maturity. It would have to be some type of, like I said, provision or, stated in the bond contract. Convertible, commodity-backed, deep discount bonds. So convertible bonds have a provision in the contract where they can be converted to stock at a period in time or after a period in time. Commodity-backed bonds are bonds that are usually backed by some type of commodity like oil or silver or gold, for example. And then deep discount bonds, just like it tells us in our book, with the deep discount bonds also are referred to as zero interest debenture bonds, are sold at a discount that provides the buyer's total interest payoff at maturity. Registered versus bearer bonds. So registered bonds are registered to a particular investor, whether that investor is, a corporation or some other type of financial institution. They are registered to a particular investor, where bearer bonds essentially belong to whoever is holding them, right? And then income versus revenue bonds. Income bonds pay no interest unless the issuing company is profitable. And revenue bonds, the interest on them is paid from specific revenue sources. And these revenue bonds are usually used, just like they tell us in the book, issued by airports, school districts, toll road authorities, government bodies, things like that. All right, so here we're looking at a corporate bond listing, or a couple corporate bond listings, Walmart and General Electric. And so it shows the maturity date. It shows the issuance of the bond, the face value, $3 million, in Walmart's case, $4 million in General Electric's case. The price of the bond, and this is a percentage of face value or a percentage of par. And so essentially, and we're going to see this as we go through and get practice, if this was 3,000 millions, nice, we'll just say 3,000. If this was $3,000 worth of bonds and we were selling them at 145.4% of their face value, if we take 3,000 times 1.454, we would sell these 3,000 worth of bonds for $4,362. So these are selling for greater than 100% of face value. General Electric, 4,000 times 118.2. Again, if we take 4,000 times, and that's, just like it shows here, price as a percentage of par. So this is 118.2%. So if we take 4,000 times 1.182, again, we'd be selling these bonds. General Electric would be selling these bonds for about $4,728, right? So they're selling for more than 100% of their face value. This is the interest rate paid as a percentage of par value. So 6.5% interest paid on Walmart corporate bond. General Electric 5.25% paid on their bond. All right, selling price of a bond issue. It's set by, there's several different factors involved. The state of the economy, the interest rate set by the federal government, supply and demand of buyers and sellers, the risk of the bond, again, market conditions, the state of the economy. These things can all impact how much bonds are sold for and how much they're worth. And just like it shows here, and we're going to see this when we look at examples of the calculations, we value a bond at the present value of expected future cash flows. So when we think about, and again, we're going to see this because we're going to look at examples, we're going to get practice with it. And in fact, we've already gotten a little bit of practice with it in chapter 6, but basically we're going to use the present hot dog. We're going to use the present value of 1 for the principal. And this is going to be true for long-term notes payable also. When we're calculating present value, we're going to use the present value of 1 for the principal amount. And then we're going to use the present value of annuity for the interest. So we're going to have to refer to both of those tables, present value of 1 table and present value of annuity tables. All right, so premium versus par value versus discount bonds. So premium bonds are sold at or pay interest rather greater than market rate. So if a bond has a stated rate of 8%, the market interest rate is 6%. That means this bond is paying higher than market percent. So it's a premium bond. And that's what we looked at with Walmart and General Electric. Walmart, General Electric, they were selling for greater than 100% of face value. So premium bonds are greater than 100% of, hot dog. 100% of face value, AKA par value, right? Premium bonds are sold for greater than 100%. So with Walmart, we saw it's being sold for 145% of face value. With General Electric, we saw it's being sold for 118% of face value. Par value bonds, again, if the stated rate's 8%, the bond's paying 8%, that's a par value bond. This is sold for 100% of face value. So if we're issuing, $1,000 bonds, we're going to sell them for $1,000. They're being sold at 100% of their face value. A discount bond. So again, if we have a discount bond that's paying 8% and the market rate is 10%, that's a discount bond. So discount bonds are sold for less than 100% of face value. So as we're going to see, a discount bond might be sold for 96% of face value, or it might be sold for 98% of face value, right? Less than face value. All right, so here's an example, and based on this information, they're going to walk us through some of these calculations on the next few slides. It says, Service Master Company issues 100,000 in bonds due in 5 years, which means they mature in 5 years, with 9% interest payable annually at year end. At the time of the issue, the market rate for such bonds is 11%. Okay, so if the market rate is 11, that's the market rate, right? Market rate for such bonds is 11. And these bonds are paying 9% interest. That means that this is going to be a discount bond, right? We can already tell without even plugging any numbers in, without even doing any math, the market rate is 11%. We're only Service Master. Service Master is only paying 9%. This is going to be a discount bond then. So if this is 100,000 worth of bonds they're going to sell these bonds for less than 100,000. Remember, less than 100% of face value for discount bonds. So anyway, we see here the interest that's paid, the principal amount that's due. So companies, when they issue bonds, not only do they have to pay this principal amount, this is due at maturity, due to bondholders at maturity, but then we also have to make these periodic interest payments, right? Okay, so here's our example of that. Remember, we want to take the present value of the principal. And so this is present value of 1. And then we want present value of the interest payment. So this is present value, hot dog. Present value of annuity. It's not a very good V, but present value of annuity, right? So if we take that present value of the principal, present value of the interest payments, again, we're selling this bond at $92,608.10. Right? A discount bond. Remember, this is $100,000 worth of bonds, but we're selling them at $92,608.10. This is a discount bond, right? Bond selling at a discount. And what ends up happening, the difference between those two, which let's figure it out real quick, and they probably show us this on the next slide, but 100,000 minus 92,608.1 means the difference there, if we take our 100,000 minus 92,608.10, the difference is 7,391.90. And this is what is going to be added to interest expense. Added, I can write here, added to interest expense. Right? Because we're going to take this represents the discount on bonds payable. And this discount is going to be amortized. It's going to be added to interest expense over the life of the bond. And we'll see that on the amortization schedule. All right, so here's another example. It says Buchanan Company issues a par 10-year term bond with par value of 800,000. Dated January 1, 2017, and bearing interest at an annual rate of 10% payable semi-annually on January 1 and July 1. It records the following entry. So on the date of issuance, we're going to debit cash, credit bonds payable, 800,000. This is a par value bond, so there's no discount on bonds payable. There's no premium on bonds payable. They're being issued at par. So we're debiting cash, crediting bonds payable. And then the journal entry to record the first semi-annual interest payment on July 1, 2017. So remember, it's principal times interest times time, right? Is how we calculate that. So the interest expense 40,000, it's showing you how it's calculated here. 800,000 is the principal times interest, and then it's these bonds pay semi-annually, so it's 6 months or half of a year, right? And then the journal entry to accrue interest expense at December 31. Because interest is paid on January 1 and July 1, well, at December 31, we've got to close our books. And so we have to recognize the interest expense. And so it's going to look very similar to this, except for instead of crediting cash, we're going to credit interest payable because we're closing our books as of December 31st. We're not going to pay it until January 1st. So it's just going to be in that payable account essentially until the next day when it's paid in January is what that one would look like. All right. Here's another example, and now this one's going to show us an example of a discount bond, right? And we're at 97, that's 97% of face value. So it says if Buchanan Company issues 800,000 of bonds on January 1, 2017 at 97 and bearing interest at an annual rate of 10% payable semi-annually on January 1 and July 1, it records the issuance as follows. So again, we're taking 800,000 times 0.97. So we're actually selling these bonds for 776,000. So we're going to debit cash for 776,000, debit the discount on bonds payable for 24,000, and then credit bonds payable for the entire 800,000. And again, this discount that we're given off the top, right? This is amortized over the life of the bond and becomes or is added to interest expense. So not only are we going to have the interest expense, you know, because we're paying 10% interest twice a year, but then this discount on bonds payable is added to interest expense as well. So it says Buchanan records the first semi-annual interest payment and the bond discount on July 1, 2017 as follows. Remember, it's principal times interest times time, right? So if we're looking at that entry, it would be debit interest expense, credit the discount on bonds payable, credit cash. And so it's showing you up here how we calculate or how we amortize that discount. And we're going to see this, I believe the next slide shows us this amortization table, but we're going to use the straight line method and we're going to amortize 1,200 of the discount every period. And so that 1,200 is going to move basically out of the discount on bonds payable account into the interest expense, right? And we got that number just by taking that discount, 24,000, and this is a 10-year bond, interest is payable twice a year, so 24,000 divided by 20. At December 31, 2017, Buchanan makes the following adjusting entry. So we've got to do, you know, essentially the same thing. The difference is, though, we're crediting interest payable instead of crediting cash, right? Up here, we credited cash because that was mid-year. This one, we're closing our books out at December 31. We're not paying the interest until the next day, January 1. So it goes into interest payable until it's paid. All right, now here's an example of a premium bond, right? And so this bond is being issued at 103 or 103% of face value. Again, if we take 800,000 divided by 1.03, we're going to sell these bonds for 824,000. And so we see the debit to cash for 824,000. This is a premium bond. So remember, with a discount bond, we debited the discount. With the premium bond, we credit the premium. And then, of course, credit bonds payable for the entire amount due at maturity. It says Buchanan records the first semi-annual interest payment and the bond premium on July 1, 2017. So remember, with the discount bond, we added the discount to our interest expense. With a premium, this gets deducted from interest expense. It doesn't get added to interest expense, deducted from interest expense. Oh, hot dog, hold on. From interest expense. And so we'll see the example of that. But Buchanan records the first semi-annual interest payment and the bond premium on July 1, 2017 as follows. So again, we're debiting that interest expense, but instead of debiting the interest expense for 40,000, we're only debiting the interest expense for $38,800. We're debiting the premium on bonds payable for $1,200. We're crediting cash for $40,000. So again, when it's a discount bond, that discount gets added to the interest expense. When it's a premium bond, that interest gets or that premium gets deducted from the interest expense. At December 31st, 2017, Buchanan makes the following adjusting entry. It's going to look exactly the same, except for it's going to say credit to interest payable. Again, we pay interest on January 1. So we've got to close our books at December 31, but we're not paying it until the next day. So then we're crediting interest payable instead. Okay, so accounting for bonds, the effective interest rate method produces a periodic interest expense equal to a constant percentage of the carrying value of the bonds. And so we're going to look at the amortization tables now. And so we're going to look at how we calculate these by taking on this first part, the carrying value of the bonds at the beginning of the period times the effective interest rate. And whatever that equals, we take that number minus the face value of the bonds times the stated rate to get that amortization amount. And so we see this example here. It says Evermaster Corporation issued 100,000 of 8% term bonds on January 1, 2017, due on January 1, 2022. So these are 5-year bonds with interest payable each July 1 and January 1. Investors require an effective interest rate of 10%. Calculate the bond proceeds. So again, we've got to figure out the present value of the principal and then the present value of the interest. And you see, to get these numbers, these present value factors, we use that effective interest rate, 10%, right? And actually, I guess I should back up a minute. Remember, these bonds are paid twice a year, July 1, January 1. So it's 10% per year, which equals 5% every 6 months. Right? So when we're looking at the periods. And then also you see here, and so that's the 5% I was referring to. But then also you see here the 10 periods. Well, this is a 5-year bond, right? But the interest is paid twice per year, so that's 10 periods. So 5-year bond paid twice a year equals 10 periods. All right, and we can see, again, this is a discount bond. And, you know, if the market rate is 10% and we're only paying 8%, that's a discount bond, right? And we see that here. 100,000 worth of bonds being sold for 92,278, right? That's a discount bond. So again, that journal entry, debit cash for the amount of cash coming in from the issuance, debit the discount on bonds payable, credit bonds payable. Remember, this gets added to interest expense through the amortization process. Okay, here's an example of that amortization process, right? And so remember, this is the carrying value of the bonds at maturity. This is the amount of cash proceeds that we sold these bonds for. And we have that discount on bonds payable. The total amount of the discount is this 77.22, right? But now every time we pay interest, we have to record a little bit of the expense and a little bit of the discount on bonds payable that's been amortized, right? So to calculate the amount of cash we're paying, we're taking that, you know, basically this is the, see if I can write it maybe better up here. This 8% is the stated rate. of the bond. And this 10% is the effective rate of the bond, effective rate of the bond, right? So to calculate the amount of cash that we're paying, just like it shows us down here, we're taking our 100,000 worth of bonds times that stated rate times time, half a year, so 4,000. But remember, we get to amortize some of that discount. We get to add some of that to the interest expense. And so we get that number by taking the carrying amount of the bond times the effective interest rate times half of the year. And so we're going to pay out cash of 4,000, right? Like we see here, we're going to pay out cash of 4,000, but we get to claim 4,614 worth of interest expense because part of that is from our discount on bonds payable. And that's how we amortize that discount on bonds payable over the course of the bond's life. And it says, so the journal entry to record the first payment and amortization of the discount on July 1. So we're going to end up, debiting interest expense, crediting cash, crediting discount on bonds payable. We looked at one of these already, is what that looks like. Okay, effective interest method when it's a premium bond. So this one says Evermaster Corporation issues 100,000 of 8% term bonds on January 1, 2017, due on January 1, 2022, with interest payable each July 1 and January 1. Investors require an effective interest rate of 6%. Calculate the bond proceeds. So again, we want the present value of the principal. We want the present value of the interest. And that's going to tell us, again, we've got 100,000 worth of bonds. We're selling them for 108,530 because this is a premium bond. So we're going to end up debiting cash for 108,530, crediting the premium for 85,30, crediting bonds payable for the amount due at maturity. We saw an example of this already. And then looking at this on the amortization schedule, remember when it's a premium, this gets deducted from interest expense. Okay. And so it shows us that example here. Again, we're looking at taking the amount of cash that's being paid out, but this time we're minusing or subtracting the premium. And so the actual amount of interest expense that we get to claim, $32.56. So again, this would be, debit to the interest expense, debit to the premium on bonds payable, credit to cash is what that one would look like. All right. Long-term notes payable, like I mentioned at the beginning of the PowerPoint, and, we did get practice with this back in chapter 6. It's very similar where with long-term notes payable, we have to calculate present value, and we have to calculate present value of both the principal amount of the loan and the interest. So we use present value of 1 for the principal amount, and then we use present value of annuity for the interest, just like we did with bonds, very similar. So here's our example of that. It says Scandinavian Imports issues a 10,000 3-year note at face value to Bigelow Corporation. The stated rate and the effective rate were both 10%. Scandinavian would record the issuance of the note as follows. So we've got the debit to cash, the credit to notes payable. We have seen that before. Scandinavian imports would recognize the interest incurred each year as follows. So remember, it's principal times rate times time. So as we see here, here's the principal times rate. And this is just 1 year, so it's just multiplied by 1. They don't show the 1 here. It's kind of assumed or whatever, because this is just an annual, interest is paid annually, not twice a year. And these were apparently issued at the beginning of the year, so it's a whole year's worth of interest, right? It wasn't issued in the middle of the year, for example. So debit to interest expense, credit to cash. All right, 0 interest bearing notes. So the issuing company records the difference between the face amount and the present value as a discount and amortizes that amount to interest expense over the life of the note. So here's our example of that. It says Turtle Cove Company issued a 3-year 10,000 0 interest bearing note to Jeremiah Company. The implicit rate that equated the total cash to be paid 10,000 at maturity to the present value of future cash flows, $7,721.80. Cash proceeds at the date of the issuance was 9%. Turtle Cove records issuance of the note as follows. And so we see that entry here, debit to cash, debit to the discount on notes payable, credit to notes payable. All right. And here's what that would look like on the amortization schedule. Again, this is the carrying amount of the note. So to calculate our interest expense, and again, we just, there's not an explicitly stated interest rate, but we know that we have to pay, 10,000 at maturity, right? So then as we go through, we have to amortize this, this discount on the notes payable and charge it to interest expense. And so we calculate that by taking the carrying amount of the note times the 9% interest. So we're going to amortize in the first year $694.96. That's the amount of interest we're going to expense, and that amount gets added to the carrying value. So then the next year we would take this 8416.6 times 0.09 to get the next year 751 or 757.51, right? And then that gets added. So then next time we would take 9174.27 times 0.09, right? All right, so anyway, after the first year, we're debiting interest expense, crediting discount on notes payable. Not too bad, I think. Again, we got practice with some of these calculations back in chapter 6. So, okay, here's another example. This one says Marie Company issued for cash 10,000 3-year note bearing interest at 10% to Morgan Corp. The market rate of interest is 12% and the stated rate is 10%. The present value of the note is calculated to be $9,520. Marie Company records the issuance of the note as follows. Again, debiting cash, debiting discount on notes payable, crediting notes payable. And we see that we base, that this is our stated rate, right? The stated rate. And this is, the market rate or the effective rate, right? And so to get the amount of cash that we're going to be paying on this, we're taking that $10,000 note times 10%. So we're going to pay out $1,000 in cash, but we get to amortize some of that discount on notes payable. We get to charge that to interest expense. So, you know, we would end up debiting cash, debiting the discount, or excuse me, debiting interest expense, crediting cash, crediting the discount on notes payable. All right, special notes payable situations, notes issued for property, goods, or services. So when exchanging the debt instrument, or AKA the note, when exchanging the debt instrument for property, goods, or services in a bargained transaction, the stated interest rate is presumed to be fair unless no interest rate is stated, the stated rate is unreasonable, or number three, the face amount is materially different from the current cash price for the same or similar items, or from the current fair value of the debt instrument. Choice of interest rates. If a company cannot determine the fair value of the property, goods, services, or other rights, and if the note has no ready market, company must approximate an applicable interest rate. The choice of rate is impacted by prevailing rates for similar instruments or other factors such as any restrictive covenants, collateral, payment schedule, and then the existing prime rate, prime interest rate. Mortgage notes payable. So a promissory note secured by a document called a mortgage that pledges title to property as security for the loan. This is the most common form of long-term notes payable. And some would say, you know, part of what is considered the American dream, right? Once you own a home, that's part of that American dream. Payable, at least to me anyway, payable in full at maturity or in installments. There are fixed rate mortgages, which are, optimal, or there are variable rate mortgages, which are suboptimal, or also called subprime mortgages. Okay, the fair value option. Companies have the option to record fair value in their accounts for most financial assets and liabilities, including bonds and notes payable. FASB believes that fair value measurement for financial instruments, including financial liabilities, provides more relevant and understandable information than amortized cost. Here's an example of that fair value measurement. It says non-current liabilities are recorded at fair value, with unrealized holding gains or losses reported as part of net income. So here's our example. It says Edmunds Company has issued 500,000 of 6% bonds at face value on May 1, 2017. Edmunds chooses the fair value option for these bonds. At December 31st, 2017, the value of the bond is now 480,000 because interest rates in the market have increased to 8%. So remember, if we would have recorded this bond like we looked at in the previous examples, if we issued 500,000 worth of bonds for face value, we would have debited cash 500,000, credited bonds payable 500,000, right? That would have been our entry. But if we're using the fair value option and now the bond is 480,000, right? We see here that we have to back out that 20,000 basically. So then we would debit bonds payable, credit unrealized holding gains or losses. And who knows, you know, if interest rates change again and maybe they go back down to to 6%, then we would just do a reversing entry, right? If interest rates continue to increase, we might, do this entry again at the end of the next year or whatever, right? Okay, off-balance sheet financing. Off-balance sheet financing is an attempt to borrow money in such a way to prevent recording the obligation. I know some of you, we've talked about before the Enron scandal. This is kind of part of what Enron did that, eventually led to their downfall is they created kind of these subsidiary companies to hide their debt, basically, where it looked like if you looked at Enron's financial statements, they look like a, very financially healthy company. But again, they were hiding some of their debt in these subsidiary companies that they created. So some different examples of this: non-consolidated subsidiary, special purpose entity, or operating leases. Someday, I used to like to show that Enron documentary. I own the documentary, but it's called The Smartest Guys in the Room. And I used to like to show it in class when we were, had a break or had some free time. But with everything going on, we haven't had any free time in class. Okay, anyway. All right, so, the rationale for off-balance sheet financing, the reason why it's done: removing debt enhances the quality of the balance sheet and permits credit to be obtained more readily and at less cost. Loan covenants often limit the amount of debt a company may have. These types of commitments might not be considered in computing the debt limitation. Some argue that the asset side of the balance sheet is severely understated. So, there are problems with it. And like I said, this was one of the things that Enron did. They hid their debt in these kind of shell companies or subsidiary companies, and, tricked a lot of people. Okay, presentation of long-term debt. So note disclosures generally indicate the nature of the liabilities, maturity dates, interest rate, call provisions, conversion privileges, restrictions imposed by the creditors, and assets designated or pledged as security. Fair value of the debt should be disclosed, and then also must disclose future payments for sinking fund requirements and maturity amounts of long-term debt during each of the next 5 years. And so when we talk about sinking fund, that's like funds that we have set aside for some type of upcoming project or some type of upcoming something. So if we are going to have like future payments into a sinking fund that are of a material amount, those have to be disclosed. All right, and then finally, some of the ratios that we can do to analyze long-term debt. So the debt to assets ratio and the times interest earned ratio. So debt to total assets, we're just taking total liabilities divided by total assets. And just like it shows here, the higher percentage of liabilities to total assets, the greater the risk that the company may be unable to meet its maturing obligations. So, just to make the math easy, let's say that we've got, liabilities of 80,000. We've got assets of 100,000, right? That's an 80%, or if we write it in ratio form, 8 to 1, basically. Oh no, I'm getting that backwards. They don't show it as a ratio on this one. I want to show, do they show it as a percent, or maybe they show it as a decimal? But either way, that means of our 100,000 worth of assets, 80,000 of them are financed by debt. So that's a very high, in other words, we only own 20% of our assets, right? So that's a high debt to assets ratio. And then times interest earned ratio. This is essentially how many times over we could afford our interest, right? Because, in any debt, whether it's, credit card debt or student loan debt, as long as we can pay the interest expense, then that debt remains current. If we're unable to pay the interest expense, that's when, the loan can be defaulted on, basically. So the times interest earned ratio indicates the company's ability to meet interest payments as they come due. So we look at income before income taxes and interest expense. Basically, another way to say this, we look at operating income divided by interest expense. All right, so here's our example of both of these. It says Target has total liabilities of 27,407 million, total assets of 41,404 million, interest expense of 882 million, income taxes of 1,204 million, and income from continuing operations of 2,449 million. We compute Target's debt to total assets and times interest earned ratios as follows. So debt to total assets, again, we're taking total debt, 27,404, right? That's our total liabilities, divided by total assets, 41,404. And that gives us that debt to assets, and it is shown as a percentage. I think it can be shown both ways. It's up to, it's up to the company. Essentially, this analysis, when we do these ratios and stuff, this can be done by financial analysts and outside investors and things like that, but we also do these things internally as well. So, it's up to the company, when they're doing it internally, how they want it presented, right? And then finally, times interest earned, we're taking the income from continuing operations, and then we're adding back in the interest expense, we're adding back in the income taxes and dividing it by that interest expense. So we can pay our interest 5.14 times over to remain out of default, right? To keep our debt current. All right, here's some of the exercises and problems that I have picked out for this chapter. And so we'll see how many of them we get through in class together. I'm going to stop sharing my screen now. Hello there, everybody. Okay. All right. Well, I look forward to doing some of these with you in class together. I'll see you guys soon. Bye-bye.